So let's talk about what has been happening on Wall Street this week because things have gotten a little crazy. And honestly, if you haven't been paying attention, you might have missed one of the most dramatic stretches the stock market has seen in a while. We're talking big drops, scary headlines, oil prices shooting up, and a whole lot of nervous investors trying to figure out what to do next. So grab a seat because we're going to break all of this down in the simplest way possible. Let's start from the beginning. The stock market is basically like one giant score where people buy and sell tiny pieces of big companies. When people feel good about the world and the economy, they buy more of those pieces and the prices go up. When people get scared, they sell those pieces fast, the prices drop, and the market goes down. That's really the heart of it. And this week, people got scared, really scared. Here's the thing. It all started with something happening very far from Wall Street. There's a major conflict that has been growing in the Middle East involving the United States, Israel, and Iran. Without getting too deep into the politics, what matters for the market is this. The Middle East sits on top of a huge portion of the world's oil supply, and when fighting breaks out in that region, people immediately start worrying that oil is going to get a lot more expensive. And expensive oil, that's a problem for pretty much everyone. Over the past week, oil prices have surged dramatically, with West Texas Intermediate crude, which is the main measure of American oil prices, jumping more than 8% in a single day to break above $80 a barrel, hitting its highest level since mid-2024. Now, why does that matter to regular people? Think of it this way. When oil gets expensive, gas gets expensive. When gas gets expensive, trucks cost more to run. When trucks cost more to run, everything those trucks are carrying, your groceries, your Amazon packages, your furniture, all of it costs more to ship. And when things cost more to ship, prices at the store go up. That's called inflation, and it's one of the things the market hates most. Now, this is where it gets interesting. Shipping companies have actually suspended operations through the Strait of Hormuz, which is a super important stretch of ocean that a ton of the world's oil passes through, and they're rerouting ships all the way around the southern tip of Africa instead. Picture it like a major highway getting completely shut down, and every single truck having to take a detour that adds hours to the trip. That's what's happening with global shipping right now, and it's making everybody nervous about the cost of everything. So what did Wall Street do when all this started? Exactly what you'd expect. It freaked out. On Thursday, March 5th, the Dow Jones Industrial Average, which is one of the most famous measures of how the stock market is doing overall, dropped more than 1,000 points, falling 2.17% in a single session. 1,000 points in one day. To put that in perspective, that's like if you had $100 in your piggy bank on Wednesday, and by Thursday afternoon, it was worth about 98 bucks. Doesn't sound that bad when I put it that way, but multiply that across trillions of dollars of investments, and you start to understand why people are sweating. The S&P 500, which tracks 500 of the biggest companies in America, also fell more than 1%, and the Nasdaq, which is heavy on tech companies, dipped about 1% as well. Nearly every corner of the market took a hit. About 83% of stocks in one major index finished the day in the red, meaning they lost value. That's not a market having a bad day in one spot. That's almost the whole thing turning red at once. And this is the part people are really watching. There's a special measurement that traders use to figure out how scared the market actually is. It's called the VIX, or the volatility index, but most people just call it the fear index. Think of it like a thermometer for market worry. When it's low, investors are calm. When it starts climbing, investors are getting nervous. This week, the VIX jumped 21% in a single session, hitting 25.67. That's well above the level that usually signals the market is feeling uncomfortable, and it tells us that professional traders and big institutions are actively buying insurance against further drops. In other words, the smart money is bracing for more bumps. Now, who got hit the hardest? Great question. Airlines took a big beating this week, with United Airlines and Delta Airlines both falling more than 5% in a single day, as rising oil prices directly hit their profits since jet fuel is one of their biggest costs. Think about it. Airlines buy millions of gallons of fuel every single day. When fuel suddenly costs a lot more, that money has to come from somewhere, and investors know it. Travel stocks more broadly got hit too, with hotel chains like Marriott and Hilton each falling several percent, and online booking platforms like Expedia and Booking Holdings sliding as well, as the Middle East conflict disrupted international travel. Basically, anything connected to people moving around the world got hammered. But wait, it gets a little weird. Not everything went down. Energy companies actually did well this week because higher oil prices mean bigger profits for the companies that drill and sell oil. So while airlines were bleeding, oil and gas stocks were quietly having a party. That's one of the strange things about the stock market. Even in a rough week, some parts of it can be doing just fine or even booming. It all depends on what the crisis is and who benefits from it. Here's the thing about regular Americans during all of this. If you have a retirement account, a 401k, or any kind of investment, you probably felt this week in your stomach a little bit. Seeing your account balance drop is stressful, even when you know you're in it for the long haul. But here's something important to remember. Markets have been through scary moments before. Wars, pandemics, financial crises, and historically, the stock market has eventually recovered from all of them. There is actually a long history of stock markets largely bouncing back after geopolitical conflicts once the initial shock wears off. That doesn't mean this time is guaranteed to follow the same script, but it does mean you probably shouldn't panic and sell everything just because a few bad days showed up on your screen. Now let's talk about what the big money players, the hedge funds and institutional investors, the people who move billions of dollars around every day, are actually thinking right now. A lot of them are doing what's called playing it safe. That means moving money out of risky stocks and into safer places like gold and treasury bonds. Gold prices actually surged more than 2% in a single session this week, pushing the precious metal to near $5,400 an ounce. Gold is what's called a safe haven. When the world feels unstable, people park their money there, like hiding it under a really fancy mattress. The fact that gold is climbing tells you a lot about how uncertain things feel right now. What are traders watching going forward? A few things. First, how the situation in the Middle East develops. If things calm down and oil prices start coming back down, you could see markets recover pretty quickly. But if the conflict expands or the Strait of Hormuz is disrupted for weeks or months, that's a much bigger problem. Second, traders are closely watching inflation data. Earlier this month, producer prices, which measure what businesses pay to make things, came in hotter than expected, which kept investors on edge. Hot inflation plus expensive oil is a combination that makes the Federal Reserve, which is basically the referee of the American economy, very uncomfortable. The Fed controls interest rates, and if inflation starts running hot again, they might have to raise rates, which would make borrowing money more expensive for everyone, from home buyers to big corporations. And here's something that doesn't get talked about enough. The job market is also sending mixed signals right now, with planned layoffs dropping sharply in February compared to January, but hiring plans are down significantly from a year ago. So companies aren't firing a ton of people, but they're also not rushing to hire. That's kind of a frozen-in-place feeling, and when businesses feel uncertain, they tend to hold back, which slows the whole economy down. Now, zooming out a little, this week's chaos didn't come completely out of nowhere. Analysts at major research firms had already been warning at the start of 2026 that this was going to be a more volatile year than 2025, with a lot of moving parts, including geopolitical uncertainty, new trade negotiations, and the transition to a new Federal Reserve chair coming up in the spring. So while this week's market drops felt sudden, the foundation for a bumpy year was already in place. The Middle East situation just turned up the heat a lot faster than most people expected. So what does all of this mean for you, for your family, for the everyday American going to the grocery store or filling up their car? In the short term, gas prices are probably going to stay elevated or even climb a bit more if oil prices don't come back down soon. That affects your wallet directly. Anything that gets shipped, which is almost everything you buy, could get a little pricier too. If you're planning to take an international trip this year, keep an eye on airfare because airlines may pass those fuel costs on to passengers eventually. And this is the part people are really watching. If oil prices stay high and inflation picks back up, the Federal Reserve faces a really tough choice. Do they raise interest rates to fight inflation, which could slow down hiring and growth, or do they hold steady and hope things settle on their own? There's no easy answer, and that uncertainty is exactly what keeps Wall Street jumpy. The long game here is harder to predict, but here's the big picture. The American economy is strong in a lot of ways. Corporate earnings for many companies are still solid. The job market, while slower than last year, hasn't fallen apart. Consumer spending is hanging in there. These are signs that the underlying economy has some muscle to it, even when the headlines are scary. Here's the thing, and this is probably the most important thing to take away from all of this. Markets are emotional in the short run. Fear spreads fast, and sometimes investors overreact to bad news. Then reality settles in, calmer heads take over, and prices start to adjust back. That doesn't mean every drop recovers overnight.
Sometimes it takes months, but panic is almost never a good investment strategy. So whether you're a regular person with a retirement account, a small business owner watching your costs go up, or just someone trying to understand what the heck is happening, here's the simple version of this week. The world got a little scarier because of rising tensions in the Middle East. Oil prices shot up, the stock market dropped sharply, the fear index went up, airlines and travel stocks got hurt the most, energy companies made some money, gold went up because people were looking for safety, and now everyone is watching very closely to see what happens next, whether it gets better or whether the turbulence is just getting started. Stay informed, stay calm, and don't let the red numbers on a screen make you do something you'll regret later. That's the play.